You've got $100,000 to invest. Now, where should it go? Should you go with VOO for its steady growth, or does JEPI's higher yield fit your retirement goals better? It's not an easy call, but it's an important one, especially when you're looking to maximize every dollar for those golden years. In this video, I'm putting these two ETFs head-to-head. I'll break down JEPI's impressive dividend yield and compare it with the VOO index-driven growth strategy to see which one will help your $100,000 thrive. I'll show you their strategies, review their performance, and in the end, I'll show you how much return you can expect from a $100,000 investment over the next 10, 20, and 30 years. Both offer solid returns, but one has the potential to add an extra $1 million to your valuation, while the other has the potential to pay over $12,000 in monthly dividends. Alright, first, let's break down what each of these ETFs is all about so you can get a better idea of how they align with your investment goals. When you're comparing ETFs like VOO and JEPI, it's important to understand what each one is designed to do. Both have been gaining attention from investors, but for different reasons, which can make it tricky to choose between them. Let's break them down in a way that's easy to follow. First, VOO, or the Vanguard S&P 500 ETF, is all about long-term growth. When you buy VOO, you're essentially buying a small piece of the 500 largest companies in the United States. These companies are the big names you've heard of, like Apple, Amazon, Google, and others. VOO is what we call a passive ETF. It simply tracks the S&P 500 index, meaning it follows the stock market rather than trying to beat it. Meanwhile, JEPI, or the JP Morgan Equity Premium Income ETF, takes a very different approach when compared to VOO. While VOO focuses on growth by riding the wave of the stock market, JEPI is more about generating income. It does this by investing in large-cap stocks, similar to VOO, but it adds an extra layer with something called a covered call strategy. Now, don't let that term scare you. It's just a fancy way of saying that JEPI sells options on some of the stocks it owns to generate extra income. This makes JEPI a great option for people who want regular cash flow rather than waiting for their investments to grow over time. In short, both are strong choices, but they serve different needs. VOO is for those who are okay with ups and downs in the market because they know that in the long run it tends to go up. On the other hand, JEPI is for people who like a steady income and want to cushion the impact of market volatility. Now that we've covered the basics, let's take a look at how their holdings are structured and what that means for your investment. JEPI and VOO have distinctly different approaches when it comes to their holdings. JEPI, the JP Morgan Equity Premium Income ETF, spreads its investments across a variety of sectors, with technology making up 19.71% of the portfolio, followed by healthcare at 15.02% and industrials at 13.74%. This diverse mix also includes defensive sectors like consumer defensive, which has 10.47%, and utilities, which has 6.03%. This diversification helps reduce risk and generate steady income. JEPI's top holdings include Trane Technologies, Meta Platforms, Progressive Corp, and Microsoft, highlighting a balance between tech giants and more stable income-generating companies. On the other hand, VOO, the Vanguard S&P 500 ETF, is much more concentrated in technology, which makes up a massive 32.34% of its portfolio. The next largest sectors are financials at 12.86% and healthcare at 12.2%. VOO's top holdings feature tech behemoths like Apple, which covers 6.96%, and Microsoft, which has 6.54%, along with Nvidia and Amazon. This concentration in tech makes VOO more growth-focused, but also more vulnerable to market volatility, especially if the tech sector underperforms. Both funds offer large-cap exposure, but VOO leans more heavily into high-growth areas, while JEPI aims for income and stability. With the holdings in mind, let's see how these ETFs have performed in recent markets. Understanding how VOO and JEPI have performed in the current market is key to making the right investment decision. Both ETFs have shown strong performance, but they do so in different ways, reflecting their unique investment strategies. VOO, as an S&P 500 ETF, has historically done well, especially in the long run. Over the past 10 years, VOO has delivered an impressive 201.46% price return, reflecting the growth of large-cap companies in the U.S., particularly in sectors like technology and healthcare. Despite the market's volatility in 2023 and 2024, VOO has remained relatively stable because it's tied to the biggest companies in America, which tend to recover quickly from downturns. Long-term investors love VOO for this reason. It's a bet on the long-term success of the U.S. economy. On the other hand, JEPI has performed differently due to its focus on generating income rather than growth. Since inception, JEPI's price return is 18.08%, significantly lower than VOO's. This reflects JEPI's more conservative income-generating strategy, which prioritizes consistent returns over significant price appreciation. JEPI's covered call strategy helps it generate steady returns even when the market is flat or slightly down. In recent years, particularly during uncertain economic conditions, JEPI has been an attractive option for conservative investors who are more focused on income stability instead of rapid growth. JEPI's ability to generate income through its covered calls means that even when stock prices aren't soaring, it can still provide attractive yields, something income-focused investors love. However, as reflected in the chart, JEPI doesn't have the same potential for long-term price appreciation as VOO. So while JEPI delivers on income, you might not see the same level of capital growth that VOO provides. In the end, I'll show you the potential returns from a $100,000 investment over 10, 20, and 30 years from both ETFs. Both perform well, but one has the potential to add an extra $1 million to your portfolio, while the other pays over $12,000 in monthly dividends. Next, let's explore how their dividend yield and income strategies set them apart. When it comes to income, JEPI really stands out, especially for investors focusing on generating consistent dividends. One of the main attractions of JEPI is its impressive 7.17% dividend yield, far surpassing VOO's more modest 1.3%. This significant difference is due to JEPI's unique strategy, which revolves around generating income, particularly through its covered call approach. This covered call strategy might sound complicated, but it's basically a way for JEPI to boost its income by selling options on stocks that it holds, allowing it to deliver a higher dividend rate of $4.22 per share compared to VOO's $6.77 per share. VOO, in contrast, focuses on long-term growth. While it does pay dividends, the yield is much lower. With a 4-year average yield of only 1.46%, VOO's dividends are often secondary to its growth potential. Most of VOO's returns come from price appreciation rather than dividends, as the companies in the S&P 500 tend to reinvest profits into growing their businesses rather than paying large dividends to shareholders. In this context, VOO's dividend growth is stronger, with a 3-year CAGR of 8.57%, showing a steady increase in dividend payouts over time compared to JEPI's negative 2.19% decline. JEPI's strategy also shines in providing stability, especially during uncertain markets. While it doesn't show the same price appreciation as VOO, JEPI's income generation remains consistent, making it an attractive option for conservative or income-focused investors. This consistency shows that JEPI's dividends remain steady even when markets are volatile, with monthly dividend payments offering a reliable income stream. VOO, on the other hand, offers quarterly dividends and focuses more on potential growth rather than immediate income. So look, while dividends are important, the costs associated with these ETFs also play a key role. So let's move on to their expense ratios. Costs are always an important factor when choosing between ETFs, and in this case, VOO has a clear advantage when it comes to expense ratios. The good news is that both VOO and JEPI have reasonable fees, but there's a noticeable difference between the two that could impact your long-term returns. VOO is famous for its ultra-low expense ratio, which sits at about 0.03%. This is one of the lowest fees you'll find anywhere in the ETF world. In other words, for every $10,000 you invest in VOO, you're only paying $3 a year in fees. That's almost nothing. And when you're investing over the long term, these low fees can make a big difference. JEPI, on the other hand, has a higher expense ratio of around 0.35%. Now, that's not outrageously high, but it's definitely more than what you'd pay with VOO. For every $10,000 you invest in JEPI, you're paying about $35 a year in fees. While this might not seem like a huge difference at first glance, over time, those fees can add up and eat into your returns, especially if you're holding the ETF for many years. But here's the thing, JEPI's higher expense ratio might be justified depending on what you're looking for. Remember, JEPI is actively managed, meaning the fund managers are working behind the scenes to execute that covered call strategy and generate income for you. That kind of management doesn't come free, which is why the fees are higher. You're essentially paying for the expertise of the managers to ensure that JEPI delivers a consistent income stream. And if that income stream is your priority, the higher fees might be worth it. So now that we've explored their past and present strengths, here's the real question. Which ETF has the potential to make you and John millionaires in the long run? One of them could grow your investment to nearly $3 million. Stick around to find out which one. Now let's bring it all together and see which of these ETFs has what it takes to deliver in the future. When talking about the next decade and the long-term growth potential of VOO versus JEPI, it's essential to recognize the fundamental differences in their investment strategies. Both ETFs have performed well in their respective domains, but how they might fare in the future depends on various factors, including market trends, economic conditions, and how each fund is structured to capitalize on opportunities moving forward. Let's start with JEPI. It focuses less on capital appreciation and more on providing a higher income through dividends. With a dividend yield of 7.17%, JEPI delivers a steady stream of income that appeals to investors who prioritize cash flow over growth. One thing to consider is that while JEPI's actual dividend CAGR is closer to 7.98%, we've used a more conservative estimate of 4% for future projections. This is because JEPI's covered call strategy, while stable, can fluctuate based on market conditions, making it prudent to use a more cautious, more conservative figure. The potential for long-term returns with JEPI still exists. Starting with $100,000, JEPI could grow to about $111,410 in 1 year. After 10 years, it's projected to reach a valuation of $292,578. In 20 years, the same $100,000 will be valued at $843,155. After 30 years, JEPI's portfolio value could reach $2,394,123, paying around $144,332 in annual dividends, which adds up to a monthly dividend income of $12,028. Therefore, the total value added to the portfolio is $2,294,123, with $880,065 coming from capital appreciation and $1,414,059 coming from dividend reinvestments. Of course, the big question is, can VOO beat that? Let's find out. VOO, as we've learned, is an S&P 500 ETF and has a strong history of capital appreciation, with the average annual return on share price over the past decade sitting at 11.33%. Its long-term potential is tied to the growth of the U.S. economy, particularly the technology and healthcare sectors, which dominate the fund. It has a current dividend yield of 1.3%, backed by a dividend growth rate of 7.19%. Now, if you and John start with a $100,000 investment in VOO, after 1 year that initial amount could grow to approximately $112,630. After 10 years, it has the potential to reach a valuation of $322,219 with reinvested dividends. Fast forward to 20 years, and your valuation will be worth around $1,004,285. By the 30-year mark, the value of the portfolio could reach $3,062,472, paying $10,457 in annual dividends, meaning the total value added to the portfolio is $2,962,472, with $2,826,894 coming from capital appreciation and $135,578 coming from dividend reinvestments. So here's the final judgment. VOO excels in long-term capital growth, potentially reaching $3 million, while JEPI offers steady income with a more modest growth, paying over $10,000 in monthly dividends. If you're after growth, VOO is your clear winner, but for consistent income, JEPI is the better choice. Both serve distinct investment goals depending on your priorities. Want to know how the snowball effect works, potentially turning $10,000 into a $9 million portfolio? Click the video on the screen.